Turns out the government, literally anything that they try to do, and no matter what side of the fence that you're on, whatever they say they're doing, it has the opposite effect. Stop me if this sounds backwards. Washington says it's shrinking government by kicking Fannie and Freddie Mac out of federal conservatorship, but the fine print can fatten the other government mortgage machine, FHA, right under our noses. Here's how the comedy of housing finance might play out. Step one, the twins go private with only a wink and a nod guarantee, and Wall Street cheers because profits are back on the menu. Step two, those new shareholders suddenly remember they like profits more than thin credit borrowers, so they tighten guidelines, bump up guarantee fees, and generally make it harder for first-time buyers or anyone rocking a 640 score to squeeze through the door. Step three, every one of those buyers says, fine, I'll use FHA loan. I'll use an FHA loan because FHA will take a 3.5% down payment and just about any sort of compensating factor. Now, here's the punchline. FHA is backed by you, me, and every other taxpayer who just celebrated the less government exposure. So in trying to offload risk to the private market, we might reroute the same risk straight back onto the public balance sheet. Only now it comes with mortgage insurance premiums and a nice side of irony. Prime credit borrowers, they barely notice. The 30-year fix survives because global investors still treat anything with a faint government scent like a comfort blanket. But the households who actually need flexible credit, they're either going to pay more, go FHA, or sit on the sidelines. In short, we're moving risk from one federal pocket to the other and calling it a diet. If that makes sense to you, drop a comment explaining it to the rest of us. And if you want a full, less sarcastic deep dive, the YouTube breakdown lands this week. Link is in the bio.